We are live.
Woohoo! Coming in hot, live at ya, live.
We were having way too much fun here backstage.
We are. We're excited about today. Welcome. I'm Raquel Rigby. I am the Chief Compliance Officer with Rise Capital Investments, and I'm here with my lovely business partner, Lais.
Hello. I am part of Rice Capital. I'm investor relations, so most likely you're going to talk to me if you ever schedule a call with us. So I hope you do, because I would love to get to know you a little bit more and hear about your journey. And I don't know about you, but this ghost is really creepy and it's freaking me out. I don't know who picked that.
I like it because it's a mix of like scary, but then kind of cool at the same time,
Person.
So it's like we're scared a little bit, but we're also kind of chill,
Oh my gosh,
So
that's hilarious.
yeah, this it's kind of how life goes sometimes, especially today. You know how life comes knocking on your door sometimes, and like, hey, are you paying attention? Like, what's going on? Um, I know, like today, I had to have a hard conversation with my daughter, and she's like, Mom, I don't want you to worry about me. And I think just like as parents, we're always like, I don't care. Like, I'm never not going to worry about you. Like
Yeah,
me as a baby to my mom, she's like, I
yeah,
still worry about you.
yeah.
So anyway, just
I
a
think
little
you need
bit about, yeah, what happens on the day to day. But it's one of those days where, we're here, we're showing up, no matter how scared we are, no matter what is happening in life, we're still going to show up and take
yes.
action.
Takes
And that's what we want, yes, to talk about today with everybody. And right now can be a super scary time. I mean, it's an election year. You're hearing a lot of things about what's going on and uncertainty and about what the outcome's going to be from the election and what are going to be the repercussions. I mean, I've heard different things about, you know, concerns that are kind of unusual, like apocalyptic type concerns. And I'm like, it's all right. My toilet paper stock is full. I think we'll be all right. But it's
all the
a little
conspiracy
uneasy.
theories like
Yeah, you never.
starting to pop
It's
up.
weird. Yeah, it's different compared to previous election years. So that's one concern. But besides the election, we have other kinds of concerns that people are facing, like job layoffs or inflationary costs, where people are having to increase their income just to maintain their lifestyles and things like that. So um,
Did
things
you?
might be happening with investments as well. Like, investments might be stopping distributions and might be underperforming, or, while everything's okay when that happens, sometimes it is necessary to be able to protect investments.
Yes.
Um, we also want to make sure that, we're not starting to feed into the fears of what can happen with investing. And go ahead, Lais.
No, I was just gonna ask you if you saw, because I read the Wall Street Journal, pretty often, and I was looking at this, you know, uh, piece about the default rate. So, it really jumped these past few months. It jumped up, which, tells us that people are not able to afford housing right now, which is really scary. So that's, one of the worst. I mean, it gives me '08 vibes. It's not going to happen again, but it does give me '08 vibes a little bit. I knew this would happen, especially with commercial real estate, but I didn't think it would happen as much with, the single family home market. But just seeing those default rates kind of like jump up is just a little scary overall. So, talking about scary, there's definitely a lot of scary things going on right now in the economy.
Right. And I mean, well, not everything is scary, and not everything that happens is bad. There's something that's something that we can start to feed again into our fears and scare us into thinking that, like, when is enough enough? Um, am I really working hard enough? Even though I'm working hard enough, is it enough to support my family? Is it enough to support my life? And so that's again what we're going to talk about a little bit today. So first, we're going to dive into kind of some of those myths that make us scared when it comes to investing. Some of the common ones that we think about or we hear about from investors is one, that it requires a lot of money. Housing, especially with housing prices going up so much recently in the last 5 years, it's, how am I supposed to buy all these properties? How am I supposed to fund the whole thing? Second, it's like it's a lot of work. It does take a lot to find properties, acquire them, fund them, manage them. It does take a lot of work sometimes, but and then also it is risky. You could lose money. Every dollar that you invest is considered at risk capital, and it can potentially um, de decrease in value instead of increase. So there is some type of risk when it comes to these things, but we want to show you how these shouldn't make you scared about investing, and how to instead mitigate the risk and take actions with confidence in growing your portfolio and growing your wealth. And maybe none of these scare you. Maybe it's something else that's a little bit more personal to you. Maybe you're thinking, but you're going to be underfunded for your retirement and that worries you, or you're having to maybe lower your standard of living once you retire because again it's not funded enough. There You might have to think of being afraid of having to work until you're 60 years old and not being able to retire earlier. And then also
Sounds scary.
maybe you want to provide, yeah, like a college education, or you want to be able to pay or provide housing for an older family member, or your once your kids become college age. So just some of those things that could be fueling the the fear and the scarcity mindset are some of the things that we're going to help you overcome. There is a lot of different ways to get into investing. It requires a lot of money. You doesn't have to require a ton of money. You can split up that cost with other people and go into a group of as an investment and pool your money together into a syndication, or what we do, into an investment fund where you can purchase the properties as a group, and then you share in the responsibilities, you share in the work, and you share in the profits. And so that is one way to help you not have to require a lot of money and not have to put a ton of work into it. Sorry, but also it helps again spread that risk among all of the different participants in that investment. So, and the other great thing about mitigating risk with real estate is that it is backed by a hard asset, and so you have a tangible asset that you know they say can't go to zero, but you're really securing your investment by an actual property that is income producing. So as long as it's producing income and paying for the debt, then it should be an asset that can't go to zero. And when in looking at the risk factors, it is something to consider when you're thinking about your investments, is to consider something that is less risk, which is the debt side. When you look at a property, the first person or second person to be paid back is usually the lien holder, or the person that provides the debt on the property. So it's something to think about if you want to lower your risk, if you're a little bit worried about maybe losing money, and that's one of your concerns, then you should consider investing in debt, because then your investment is backed by real estate. Your investment is also in a position to where you're going to get paid back first in the event of a sell, or you have recourse to take back that property if something was to happen to the the manager or the borrower that borrowed the money. So again, just a few things to think about when you're thinking about those scarcity things. And then again, overcoming this. We're all haunted by fears and then to a certain degree, but we can't let fear drive us. We can't let that be the steerer of the ship. We need to find ways to overcome that because success and wealth generation is really on the other side of that fear. If you step out of fear's shadow, and then financial freedom and abundance start to take life. And in that, you will be able to have more freedom, be able to make more choices, and have a little bit more peace of mind. Let me go to the next one. So again, investing can be a little bit risky and there's no profit guarantees, but nothing crumble crumbles faster than like a rickety foundation, than a structure with a rickety foundation. So take the risk out of um to so don't take the risk on building like your financial fortress on sand. You want to make sure that you're building it on a sturdy, solid foundation. Yeah, because that's going to give you the confidence again to take calculated risks and understand the fundamentals of investing. It's going to help you build that indestructible portfolio that can withstand any market and any condition, any economic shifts. Um, and really, it's to understand the fundamentals, which we'll talk about a little bit more in detail. You also need to be able to understand that it doesn't mean that you're never going to have losses or anything, but your entire portfolio will be able to sustain itself, whether there's minor losses and minor gains. It will kind of all balance itself out. And that's what diversification is really about, to be able to say, okay, if some assets, something happens with an asset in one market, another market should be able to sustain that. So it's creating it in an ecosystem of a portfolio in and of itself. So some of the fundamentals that I wanted to go over is, one, knowing your numbers. There's a lot of acronyms and abbreviations and jargon in investing. So make sure you understand what those numbers mean when it comes to the words that reference, what those numbers mean. Sorry, I'm kind of not making sense.
How you get paid, right?
Yes.
How you get
How
paid.
getting paid. What's important to you?
That's all that matters.
Pay attention to your investing goals and understand what it is that you're trying to achieve at this point, because it may change over time, but you need to be able to focus on what's important. Is cash flow important right now? Or are you trying to increase the amount of income you're bringing in monthly, quarterly, annually, to be able to sustain your current lifestyle, or to create a better lifestyle? Or maybe your lifestyle is taken care of and you're looking more for yield, you're looking more to grow your wealth and increase the value of that over time. So pay attention. This chart gives you a little bit of an understanding of the things to pay attention to specifically to cash flow. So that would be your preferred return and your cash on cash return. And then if you're looking more on the yield side, then you're going to be looking more on equity multiple and internal rate of return. Those indicate more of the yield. So is the cash flow where you need it to be? Is the yield where you need it to be? Can you want to be able to understand the full picture, but these are the ones that you want to pay close attention to based on your investment goals.
Yeah, and just to add also just some simplicity to it as well. The cash flow is something that, is like shorter, right? That return that you will receive on a shorter term. And then the yield is on the long term. And some investments, you get both, right? Which it's kind of like a win-win. Some of them you even are going to get also tax benefits. So it's a win-win-win, right? So looking at all those factors here, Raquel is talking about, will really help you understand whether that investment is good or not based off of, where you're going.
Exactly. And that's another point I was going to mention, and I'm glad you brought that up of like, um, you may get some cash flow through it throughout the investment period. And so understanding when those distribution schedules are, or when the distributions are scheduled for, that is going to be important as well. Because if you're going to get paid all at the end, then maybe that doesn't quite meet your goal. Are you going to be paid out monthly or quarterly or, semi-annually? Again, just make sure it aligns with what you're trying to achieve. Next is, oh, go ahead. Did you have something?
No, I just said love that.
Oh, love it. Okay. All right. Next is utilize leverage. So again, investments can be complex. They require multiple components. And when you try to do everything yourself, it can become overwhelming and kind of daunting. And everyone's situation is unique. So in the fact that everyone is in a different stage of their lives, um, that's okay, but we still have one thing in common, is that we all have the ability to utilize leverage. And leverage in this case is to use something that you already have or you can easily obtain in order to achieve something better. So in this case, we're going to use these things to leverage to be able to grow our portfolios, increase our wealth, um, you know, have tax, take advantage of tax benefits and things like that. So, what I recommend most people do is to run a self assessment and really analyze where you're at in life and what is it that you have access to that you can leverage to achieve your investment goals. And the first thing we're going to talk about is time. And this point of leverage is most utilized when starting out because first, it's going to take more of your time in the beginning, but as you start piling your other levels of leverage, you're going to be able to protect your time more and more as you go. So, in the beginning, you may have to dedicate a lot of time to, building your foundation, building your network, building up more money to invest, building up your experience. But as you do that, you'll be able to leverage the other things more than that time. And that is really important because time is something that is finite and we can't get it back. So we want to make sure that we're protecting that as much as we can. But if that's, what you have to give at this moment, make sure that you're leveraging it wisely. Um, the next thing is people and relationships. Uh, this one is one of the most valuable points of leverage, in my opinion, because people, like, all in all, properties, whatever, people make the world go round. We give what we give out to others, we receive as well. So I am an advocate for building relationships, building open lines of communication with people, and always expanding your network to be able to include others that you can potentially help in the future, or that they can help you, especially once when you do it with the right people, you'll be able to receive insights from others. You'll be able to gain access to deals. You'll be able to consult them to help you make maybe investment decisions, or get their point of view on an opportunity that you're looking at. You'll be able to have resources to be able to solve problems as you're growing your income, as you're growing your wealth, your problems stay in line with your income. So it's like as you're growing, your problems are getting growing and getting bigger as well. So having people to be able to consult and to talk to and can help you solve those problems is very important. And like I said before, it's like when you grow those relationships, it continuously starts to open doors with other people because you're you're constantly meeting those people. You're constantly um they're introducing you to their friends and to their friends, and it's just an exponential growth of your network. And essentially your opportunity to find investment opportunities as well. So it's just an infinite return, I believe. And um, leveraging leveraging that is going to be super important. The next thing is money. Money money's great. Money is wonderful, but it is what it is. It's a tool. So I want to um, just plant the seed of using money in that way. Money um, should be leveraged to get more money, to grow money, to be able to, again, buy back the other resources, to buy back the other things that you can leverage, to be time, experience, you know, spending, giving your money away, helping other people, being of service to others. So leveraging your money, you can do it in a couple different ways. So one is like your cash and your investing and or your savings, sorry. So with your cash and savings, once you have your emergency savings taken care of, the other savings that you have in the bank account, really it's just going to sit there. It's kind of like having a tool in your garage, if you're not making anything with it to be productive in society, it's just sitting there, devaluing over time. And it's the same thing with your cash and your savings. So if you have money in the bank, it's best to, if you don't need that for an emergency fund or if you have excess, then it's best to be putting that money to work for you. So that's one way, your cash and savings. The next would be your retirement account. Retirement accounts are the same way. Like opening a retirement account is the first step, and putting money in there is the next. But if you don't put that money to work and you don't actually place it into an investment, it's just a tax saving harbor, I guess if that's the right way to say. But so make sure that you're actually putting that money to work. And what's the good thing about retirement accounts is that you can, if it is like a solo 401k or a self-directed IRA, then you can choose which investments those retirement funds are going into. So make sure you're putting that to work and maximizing your retirement. The next thing is a life insurance policy. If you have a life insurance policy, you can borrow against your life insurance policy. The certain, whole life insurance, and there's certain policies that you can borrow against, and then you can kind of double dip that money and be growing that cash value by also investing. And then the next thing is your business cash flow. So if you have a business and you have excess cash in your business and you're looking and it makes sense for your business to invest, then do that. Or if you have an investment business set up specifically for that reason, then that's a great way to get excess money to invest.
And I was going to add to this as well, because when I was working my corporate job, I was also leveraging my employer's 401k. I was borrowing against my 401k, which I was paying interest to myself on. And I was using that capital to invest in real estate. Obviously, this is being a little bit over leverage, but I was okay with that, because the implication I would have if it didn't work out is I would continue with the job security that I had really strong job security. So with that job security that I had, I could continue to pay that loan back. And if something went badly with my real estate investments, it was okay. I would just have to potentially be penalized. However, I was still paying that money back into my 401k, which at that point it wouldn't, penalize me. I wouldn't be penalized by paying, income tax on that amount of money. But if everything, I ran my pros and cons list and saw that, it was a pro for me, the worst case scenario would be I would have to pay tax on, income tax on that capital that I pulled out. So, and it ended up working well, where I paid back in full, invested in real estate, paid myself interest. So it was a win, 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 win. So that's an alternative too. It's a little over leveraged, like I said, but since we're in the topic, I figured I'd share that story with you.
Yes, um, and I do want to reiterate that we are not financial advisors. We do not give financial advice. This is based on our experience and it's for informational purposes only. I should have said that in the beginning. I'm usually the one that covers all of that, but just so you know, always consult your own professionals, your investment advisor, and
Your
your
accountant.
financial advisor.
Yeah,
So
talk to your
yeah,
accountant.
yeah, your accountants as well. So just make sure everything is up in the up and up. But also, like you said, like it's good to know what your own risk tolerance is and what you're willing to do, um, and what moves you're willing to make in order to
Hmm.
continue investing. But just do what you're comfortable with, and that's kind of where it brings us to the next point of experience. The more that you do, the more you get experience. But it's amazing to be able to utilize and leverage other people's experience. And that's where I find it to be most useful when it comes to investing, because you're able to utilize the resources, the networks, the experience, and the problem solving skills of other people. And so what is it that you can do to utilize your experience to either build your relationships, build your money, build your ability to be creative in these ways of growing wealth, but especially when you're trying to reduce risk and increase the probability of success, utilizing the um, the experience of other people is going to be able to get you to find deals, fund deals, and manage deals as well. So, really leverage the experience of others to gain that unfair advantage.
Love that.
All right.
Awesome. So, continuing in the topic of, how do we, step away from being scared, right, to invest. And I want to go back to the basics here and talk about, goals, because everything starts with your vision at the end of the day, right? It's not my vision. It's not Raquel's vision. Um, my my rich life, my investment journey, it's all based off of my vision to what my life is going to be. So that goes back into goals. So it's super easy to get caught up in the market noise. It's super easy also to get FOMO. Everyone has FOMO these days, especially if you're a millennial, Generation Z, you for sure have FOMO, because of all the technology and all the new information that's out there and the amazing creators that are sharing educational pieces. Super easy to get FOMO. So if you don't have a clear really destination, you end up all over the place. So the first thing is like setting goals. Be very specific, right? So here's how you do it. Be very specific. Don't just say, oh, I want my money to grow. Be specific and say, I want my money to grow, I don't know, 12% this year, right? Or I want to add X amounts of properties to my portfolio this year. This gives you something more concrete to work towards and around, rather than just an idea. It's easier, it's more tangible, so you can take action based off of that number that you're giving yourself. The other item here is time frame, right? So if you're setting up a time frame, it's really crucial to set up a time frame, because if you don't have a time frame and you say, hey, I want to grow my money 12%, but if it's 12% in 1 year, that sounds pretty good, right? Especially when inflation is what, 4%, about 4% now. So you are earning there about 8%, right? Truly. But then if you say, I want to earn 12% and you don't say the time, but then if 12% is in 10 years, that's not a very good investment, right? So super important to give yourself a time frame, and to understand, it goes back to your goals as well, to understand how that ties into that, that vision, right? So are you looking for short-term results? Are you looking to grow your money within 6 to 12 months? Are you looking to grow your money within 5 to 10 years? This really helps you. The time frame really helps you just keep focus on the strategy that you're going to use, the asset class that you're going to pick, um, and just on your investment portfolio overall. So time frame, I want to say, is one of the most important things to get a hold of. And then some actionable steps here. Once you set a goal, a specific goal, and you set up a time frame, you need a game plan, right? So you need to have a game plan on how you're going to take action, and you actually need to take action on that, because a lot of people have analysis paralysis, especially in real estate. I want to say that it's a very large amount of people that take so much longer to start because of analysis paralysis. So understanding when are you going to take action is a big step there, and how you're going to get there, right? So having a plan on your action, it's super important. And it also helps you, just to focus on, okay, now is a time to find the deals, now is a time to vet the deals, and now is a time to find a team to work with me on the deal. So it really helps you outline the big picture, but just it helps you get there. And then obviously, lastly, we have to track the process, right? So check in your process, in your progress regularly, just really keeping track. It helps you avoid getting off the course. So I don't know if I remember this data properly, but I know that the airplane pilot, if they get just 1 mile, I think, off, or I don't know if it's a degree, I think it's a certain degree off course, they go to a completely different destination. So it's very important to keep track of where you currently are. Otherwise, you're gonna, the goals that you set, you're not gonna get there, right? So keep track, keep up with your investments, rebalance your investments, and also see if that still fits your goals. Can you
Yeah, and I think I would add to that is
Mhm.
by setting these goals, you're going to know exactly which investments to say yes to and which ones to say no to,
Yes.
because do they align with your goals at this point in time or do they not?
Mhm.
And as long as the numbers and the team's right, then you should be able to say yes, no, no questions, as long as it makes it more clear to you and in achieving that vision and achieving those goals along the way. So yeah,
I
keep
think
track of that.
that's a great point too that you're making, because everything on this slide, right? It really um, helps you set your buy box, essentially,
Yeah.
right? So
Hmm.
what goal do you have? What asset class fits that goal, right? And what time do you want to reach that goal? What do you need to do to get to that goal? And then tracking the process, identifying the progress really will help you get there. So it helps you also put together that buy box so you can be laser focused and get rid of FOMO.
Right, exactly. And it's not necessarily what deals you say yes to, it's what what good deals you say yes to, but it's what bad deals you say no to. And again, it's usually because it doesn't align. So,
Right.
okay, next one.
But a big deal, right? And Raquel went all about leverage, right? I talk a little bit about setting up those goals, but a way to bypass a lot of that work, right, is to pick a good team to work with. So, here's the thing, investing isn't something you have to do alone, period. Okay. So lots of people are like, oh, I have to figure this out. And, they didn't teach me this in school. How do I do it? Right. So going back to the leveraging piece, the right partners can make all the difference in whether a deal is successful or not. So picking them wisely is key. But what exactly should you look for, right? So here are some of the items I'm going to talk about. In us, Rise Capital, we are a partner, right? So here are some of the items that our investors go through when they are analyzing if working with us is ideal, right? So looking at their experience. You want partners that truly know what they're doing, because you're leveraging their experience. Going back to leverage, everything in investing is leverage, right? If you know how to use it, you definitely can get further sooner. So if those partners have a proven track record in the deals that you've narrowed down that you want to do, right, that's an interesting partner. How long have they been doing it? How long have they been doing that specific, deal? Or how long have they been, perfecting their, their, oh gosh, I'm like missing the word, but how long have they been doing
system.
Ultimately, yeah, their system, right? Because in every deal, there's something different. So the more they do it, the more they've seen. So the more prepared they are to help you get through the deal. So understanding their achievements, understanding their experience, and how many down cycles have they had, right, with the market. So just understanding how they're running the day-to-day operations, who is managing what, who is managing financials, who's managing operations. So just all of those items, are important to a deal to be successful. So understanding how much experience your partner has on all of those items is a big deal. Okay, and resources, right? So understanding the resources, it's not about just having knowledge, but your partners also need to have the resources to back up their strategy, right? So can they successfully acquire the property? Can they get the deal to the closing table, right? Do they have access to the financials and the relationship to get it to the closing table? So understanding their network as well and how you can leverage their network is a big deal. Understanding, who is going to manage the property. So the property managers is a big deal. So all of those resources are important in a real estate deal. So that's definitely something to look into. And then the most important one, in my opinion, which is their trust. Are they trustworthy? Right? This is a really, really big one, because we hear, some horror stories. Us as investors, right? The core team here, we're all investors. We partner together because we wanted to put a product together that would be something we would want to invest in. And in fact, we put our own money in. So a big thing is trust. And we hear crazy stories about people getting scammed, and because they put their trust into partners that were not trustworthy. So you definitely want to know your partners will communicate clearly with you. They will execute the plan that they agreed, upon with you, and always keep your best interests in mind and at heart. So trust starts with, transparency. So if people aren't being transparent about how they're doing their deals and how they're going to help you, that's a red flag, in my opinion. And also a big thing is having aligned goals, having aligned values, having aligned goals. Obviously, trust grows over time, but certain things if you can identify beforehand certain things that are non-negotiable to you, bring those up into, your partner's attention to see if they are a good, partner that you should be, investing with. So, really ultimately just make sure there's a clear exit strategy. Your partners have the experience, they have the resources, and you have just aligned interests and goals. Going back to your goals, right? Everything has to go back to your goals.
Yeah, and trust your gut, because it's like everything can be great. The deal's great, everything is good. But if you can't trust that, those partners are going to make the right decision when times get hard, especially like we've seen at this point, properties are may fail because the managers, not because of the property necessarily. It's just who's managing it might be the issue. So yeah, that's where it really
And,
becomes important.
and going into that as well, Raquel, I think that like when you're a busy professional, and that's funny because right when I resigned my corporate job, I took a couple months of sabbatical, right? And I could actually think and feel and be so much more in touch with, what was what. And so I feel like we live in such a rushed, in a hurry. We're pushed and pressured to do so many things. So it's hard sometimes to listen to your gut because, there's so much going on. So yeah, don't get pressured into doing anything you're not feeling comfortable with. I think that is a really big deal. And if you are, then that's a red flag. I talk about this in different, presentations where I had one of our investors. He is our investor today. And he said, our first call, he said, where do I wire? And I was like, wow, no, that should never be a thing. Right. So don't ever fall into that. If you're asking me where do I wire, perhaps you already had some of those conversations. And that's just really scary overall. You should be allowed to have the time to think about it and see if, whatever investment you were thinking about jumping in aligns with your goals, aligns with your family, and if that team ultimately is the right for you. So right. I love that you brought that up.
Yeah, like quick money would be, great, but it could backfire on the managers of like us, because if we don't have enough conversation, we don't understand your goals, and it might not be the right thing for you, and then it ends up being bad for us and bad for you as an investor as well. So we want to make sure, again, everything aligns.
Yes, and if not, we'll refer you to someone who we trust that aligns with your goals.
Abundance. Yeah, abundance. Again, into our network, you have access to our network.
Yes,
and maybe same with you. Like maybe the best investors are referrals, because we help one person, we can continue to help their network and their friends, their family, of who it makes sense to benefit.
Yes. Heck yeah. All right. Now let's talk about the fun part. The deal. Well, for me, it's the fun part because I like that part. But so, evaluating the deal itself, right? So how do we mitigate that risk so you don't feel so scared to invest, right? This is where things get real and you're about to commit, right? So super important. You want to make sure everything checks out, like we said before, before you move forward. So what should you be paying attention to, right? So first, financials, right? So financial projections. And if you do have questions, again, talk to your CPA. Your CPA, if they are a good CPA, they should have understanding of what you're doing. If they don't, run away, interview different CPAs and hire, one that has knowledge of what you're wanting to do. A lot of them sadly don't. So if you have questions on that, you can always check with your CPA. It's nice to have someone on your team that it's not part of the team to help you with that. But every deal should have solid numbers behind it. So this is a very important one, right? Are those numbers based on conservative assumptions? you want to ask yourself, is this cash flow projections realistic? Do they align with my goals? Am I going to be in this deal for 6 months? Am I going to be in this deal for 1 year? Am I going to be in this deal for 8 years? Does that align with you? Right? So take the time to dig into those details and understand, the numbers, so you have the confidence to invest in it. And again, I don't know if I'm getting ahead of myself, not a little bit, but you want to look at those returns. Are they aligned, with what you had in mind, and overall paying you what you had in mind? So dig deep, and also ask questions to your partner, right? If you don't understand, ask them a lot of questions, bring it back to your CPA, but make sure that those, financial projections are aligned with your goals. Next, the property condition. Definitely want to understand that one. I know, for an example, when I first started investing, well, not when I first started investing, but when I first started scaling my portfolio, if you would call it that way, I went for properties that didn't have the best condition and that were not in the best neighborhoods, and it was, not maybe in the best states. It didn't align with what I wanted overall. So super important, right? Because that pushed me backwards. It was a great experience for me overall. I wouldn't have traded that. But again, it definitely pulled me off the course of my goals because it didn't align, right? So you definitely want to understand the property condition. You got to know the property. And again, ask questions to your partner. But try to understand, is this a property, D property, C property? Is this on an A neighborhood, B neighborhood? I know myself, I do not invest on anything that is on a D or even C neighborhoods. I want to say that's just not interesting to me because it attracts a certain type of tenant that I'm not necessarily excited to service. I've had D tenants before, and every time we had a turn, it was $5,000 to $7,000 to redo the whole unit, right? So it's just profit leak. So look at the property condition, understand that. The more you know about the property up front, fewer surprises you have. But again, if you are partnering with a team like Rise, we are doing all of that due diligence up front, right? And so properties that are in bad condition don't align with our thesis. So that's not something that you would even be seeing. But all in all, always pay attention to the property condition. And then you want to understand the business plan, right? So a good deal always comes with a solid plan for how you're going to grow either the property value or the cash flow, right? Or both, right? So whether it's through renovations or development, increasing rents, creating a better experience for the tenants, you want to see and understand that roadmap on how you get your money back, because it is at the end of the day all about the profits, right? So it's important to make sure that that business plan makes sense, and it makes sense to that specific market that you are going to invest in and the asset class. And then finally, you want to understand, right, how are you getting paid? So let's talk about the distribution schedule. So you need to know what that looks like, when it's happening. This is where clear communication with the partners that you're about to join is very important. You want to understand when the returns are going to start coming in, because usually on deals, it doesn't start coming in till the property is stabilized. If you are doing, we have been doing a lot of debt deals lately. So you're going to receive your capital at the end of the term at the end of that deal, right? So 6 months. But some deals that we have, we pay on a monthly basis, and some deals we aim for quarterly. So you always want to have that clear understanding when you're going to get your distributions, because at the end of the day, that's when you're making money, right? And again, setting up those expectations up front, always easier not to get frustrated at the end. So make sure that you understand that.
Yeah. And yeah, I think like the main thing with this, like the deal is like trust what you're looking, but verify the information. Trust
Yes.
but verify.
Trust but verify always.
Yes. Yes.
Everything with investing.
Same with back to the foundation, the fundamentals.
Yes, trust and verify. And then I wanted to bring, we wanted to bring in a deal. So this is a deal example for you. We do this specific type of deal, once, twice a month, every month. So for instance, this is usually what happens with our investors. They, connect with us, see if it's a good fit with their goals, right? Then they will have access to our portal. We only work with accredited investors, meaning a person who earns $200,000 a year or more, or has $1 million of net worth. So they're going to send us accreditation. They're going to get access to the portal. Then they're going to see, the investments that we have live, right? So let's say they pick an investment and they decide that they're going to invest 200,000 on that investment, right? So on these debt or lending deals that we call, they're investing their capital and we're holding, usually average time is 6 months, but it could be 6 to 18 months. And, we'll have that timeline for you so you understand and see if that aligns with your goals. But usually 6 months is what we see most often, unless it's a development type of deal. So let's say you pick that investment, you decide to put 200,000 into that investment. That investment will be due in 6 months. So after 6 months, you're going to get 224,000 back because we're paying you 12% annualized return, considering it's, you're getting paid in 6 months, so half of that, right? So you're getting that capital back in 6 months. And then, usually our investors roll over just because they want to continue the cycle. We do have some investors that do pull their cash flow, so their interest out as a form of passive income, right? This is a very passive type of deal. And it's, we have, like, going back to what Raquel said, we have first position on this deal. So we try to leverage and we try to be, to reduce our risk as much as possible. So this deal, we have first position on the deal. If that borrower defaults on this deal, we would have first position, we would have first pick to take that property back. And I mean, we are a group of experienced investors. We feel very comfortable with all the exit. Usually we have at least two exit strategies before we commit to a deal. So I haven't seen one, go wrong yet within our fund, but if that's the case, we have first position. So, but again, going back, you find an investment, you put your money in, usually stays for 6 months, then you can roll that investment into a next debt deal, or you can pull that investment out. But for investments above $200,000, we're paying 12%, which is really exciting for us.
Yes, and as we're wrapping up here, if anyone has any questions, make sure to drop them in the comments and we can ask them, or we can answer any questions or address that if you need.
Yes. And then obviously we do have a live offering going on. So if you're ready, right? Because that's the thing. That's the thing with investing. I try to encourage people to even teach their kids about investing right early at an early age, and even get money invested for their kids at an early age, because time plays a huge, role. The earlier you start investing, it's just you're earning interest on your money, right? So it's your money working for you. So we do have a live offering right now. It's a very exciting one for us because it is a development. So it is a cash flow, a true cash flow opportunity. It is a residential new construction in Orem, right? So as far as returns go, we were talking about returns. So it's anywhere from 10 to 12%. So if you're investing anything below 200,000, you're getting 10% annualized return. If you're investing over 200,000, you're getting 12% return on an annual basis. This is a 9-month hold, right? So you can do the math there, how much it would be. So it is a shorter term. The returns are great, but as far as risk goes, this deal has a 51% loan to value, meaning, which it's great. We like to do deals that have 70% or less even loan to value because it reduces the risk. I said it's not that we're risk averse, but we try to be as protective as possible with our capital and our investors' capital. So we're always trying to reduce risk. So what it means, what this 51% loan to value means is that the loan we have on the property is only 51% of the property's value. So it matters because it gives us a big cushion, so in case something happens, even if the market shifts with all of the crazy talks out there, right? We're talking about scary. Even if the market shifts or costs rise, we're not over leveraged, so we can protect that investment. So there's a lot of equity on this deal up front, which adds a layer of security to our investment. And it's truly passive, because again, we do all the vetting, we do all the operations, yada, yada. So you don't have to worry about the day-to-day management because we do that, right? Constructions, or tenants in this case. There's not a tenant there, but we handle all of that. So you just get to enjoy the cash flow.
Yeah, and some of that extra leverage or some of that extra collateral is coming from cross collateralization of other properties as well. So this with the land and the development, since it's new construction, we are, getting a little bit of extra cushion in there by cross collateralizing other properties as well. So good. Yes. Good loan to value that we're doing with this one. So make sure to let us know, message us, book an appointment. You see at partnerwithbryce.com. We can talk through any of the details that you need if you are interested in this investment.
Yes.
Again, for accredited investors.
Yeah, accredited investors only. So if you're an accredited investor and you're ready to get started, schedule a call with us. We'd love to hear about your real estate investment journey. We'd love to connect, or if it aligns with our goals. If your goals align with our goals, we'd love to get you started. If not, we do have a large network. We'd love to get you redirected. But this is a slide with some of the opportunities that we have funded, and obviously the one that we have open. So, yes.
Okay. So, go with what I usually tell myself is your future self will thank you for making the decisions that you're making today.
You tell yourself when you're...
Yeah, I tell myself that all the time, so
I love
your
that.
future self will thank you. Make the hard choices. Don't be scared. Get above the fear. Stay safe out there during the holiday coming up, and we appreciate all of you guys being here.
Yes, thanks for staying with us for this hour. This was not so scary.
No, you're not scary, ladies. Thank you all. See you later.
Bye.